Hello everyone, you're very welcome back to the channel. Today we're talking about the Irish pension situation. In Ireland, the old age state pension is paid out to retirees from the Social Insurance Fund. State pension payments are the primary expenditure of this fund, followed by illness, disability and carers benefits, as well as working age income supports. The Social Insurance Fund is financed by the pay-related social insurance or PRSI contributions that are paid by employees, employers and self-employed individuals. Generally speaking, the fund aims to balance what comes in via PRSI with what goes out via state pension and other payments. Where there is a deficit in the social insurance fund, i.e. where PRSI receipts are less than fund expenditure, the difference is funded by the government through what's known as an exchequer subvention. Exchequer subventions have been required in the past, from 1953 to 1997, from 2010 to 2015, and most recently during the pandemic. While these subventions haven't been overly burdensome to Irish public finances to date, that is all set to change in the future. KPMG noted that annual deficits in the Social Insurance Fund would reach €3 billion by 2040, €15.6 billion by 2060, and €24.9 billion by 2076. Again, these are annual deficits that would need to be covered by future government spending. The net present value of these future shortfalls in the Social Insurance Fund, assuming a discount rate of 1.5%, is €271 billion, which for context is 114% of our current national debt. Clearly, this isn't sustainable. If Ireland wants to avoid expanding its already high per capita debt burden, then this problem needs to be addressed. But what exactly is the problem? The crux of the problem is the state pension system itself and the inadequacies of this system in the face of changing demographics. Ireland's old age dependency ratio, i.e. the proportion of individuals aged 65 and over as compared to the working population, is currently 25%. In other words, there are currently 4 workers for every 1 retiree in Ireland. As you can see, Ireland has one of the lowest old age dependency ratios in Europe, indicating a young population. However, by 2050, this ratio will be 46%, meaning there will be just over 2 workers for every retiree in the state. That spike is largely attributable to Ireland's baby boomers, i.e. those born between 1965 and 1985 reaching retirement. Why is this a problem? Because the Social Insurance Fund operates under a pay-as-you-go model whereby fund expenditure is financed by fund income. That means that the workers of today are paying for the retirement of the retirees of today. Idea being that in the future, when the workers reach retirement, their state pension will be paid for by the workers of the future, and so on and so forth. The problem with this system is that it's highly sensitive to changing demographics. The current rules, which dictate Social Insurance Fund income, i.e. PRSI contribution rates, and fund expenditure, i.e. weekly payment rates to pensioners and the state pension age, should, in theory, result in a balance between income and expenditure based on the current old age dependency ratio. In other words, with there currently being 4 workers for every 1 retiree in Ireland, the government is reasonably satisfied that the full state pension of €265.30 per week available from age 66 will be more or less paid for via the PRSI contributions of workers and their employers. However, as the population starts to age and more people are in retirement relative to the number of workers in the workforce, then clearly something has to change. Because if everything stayed the same, PRSI contribution rates, weekly payment rates, and the state pension age, then there simply wouldn't be enough money coming in to match expenditure. So what's the solution? The Commission on Pensions is recommending the adoption of Package 4, which would see PRSI contribution rates, the state pension age, and exchequer contributions increase between now and 2050. In other words, individuals and businesses would pay more contributions, retirees would receive the state pension later in life, and the government would allocate more money towards the Social Insurance Fund. These would be gradual changes, increasing the severity of the measures in line with the increasing old age dependency ratio in order to keep Social Insurance Fund income and expenditure balanced each year. The problem with this approach, as was highlighted by the Irish Fiscal Advisory Council, is that it leads to intergenerational inequality. Naturally, if PRSI contribution rates are to reach their peak 50 years from now to account for a higher old age dependency ratio at that time, then clearly future generations will have a higher tax burden as compared to current generations. As we're aware of the problem now, we should be looking to smooth out the burden across all generations. Therefore, the answer is not to ensure balance between income and expenditure, but rather to take advantage of Ireland's low old age dependency ratio now by building up large surpluses and reducing the burden of future generations. To achieve this, the Irish Fiscal Advisory Council recommends the establishment of a separate state pension fund that would operate as follows. Firstly, instead of gradually increasing PRSI rates over many decades, a steady state PRSI rate would be introduced by 2027. A steady state rate is the lowest rate that's sufficient to ensure the long-term financial sustainability of the fund without recourse to further rate increases. In other words, what is the PRSI rate that could be introduced today that would ensure that the state pension fund is financially stable for the next 70 years, whilst accounting for changing demographics? The council has estimated this rate to be 18.52% all the way up until 2100. That's the combined PRSI rate paid by both employees and employers. Comparatively, the Pension Commission's Package 1 PRSI rates would hit 22.85% by 2070, with further increases likely required to account for an increasing old age dependency ratio beyond 2070. Keeping PRSI rates at near constant for all generations results in fairer outcomes. The reason why this works mathematically is because the implementation of higher PRSI rates earlier creates large surpluses in the state pension fund. Why? Because the fund is collecting much more PRSI than what's needed to fulfill current state pension payments. These surpluses could then be invested into a diversified portfolio of assets in order to achieve an investment return which would further increase the size of the fund. The priority is that Ireland's baby boomers share in the burden of higher rates today, and that they continue to do so right up until the generation is retired in the 2050s. This is a more equitable outcome for future generations. The idea of a steady state PRSI rate is the crux of the council's proposition, and as is illustrated in the paper, extra steps can be taken in order to further improve outcomes. For example, if the government were to adopt the Pension Commission's suggestions for increasing the state pension age, then the steady state PRSI rate would drop to 16.78%. Likewise, investing windfall corporation tax receipts for the benefit of the state pension fund also has the effect of reducing the steady state PRSI rate. Of course, there are additional factors which need to be considered, not least of which is politics. Unfortunately, the solution which makes the most sense mathematically is not always the most politically favourable. You can imagine the discontent among voters if combined PRSI rates were to increase to 18.52% over the next 4 years, despite the fact that this would save individuals and businesses money in the long run. Likewise, if windfall corporate tax receipts were to be allocated towards the state pension fund, despite being a prudent move, segments of the voting public would argue that the receipts should have been used differently. The government's refusal to increase the state pension age and their decision to implement a new flexible system from 2024 is a case in point example of the conflict of interest that can arise between politics and public finances. There's no question that a hard increase to the state pension age is the more financially sustainable decision, but the government is trying to have its cake and eat it. Furthermore, because this entire discussion is predicated on projections which reach decades into the future, there's a significant amount of uncertainty around how things will pan out. For example, it's all well and good saying that state pension fund surpluses will be invested, but ultimately it's the performance of those investments which is going to determine the sustainability of any steady state PRSI rate. What if the indexation of state pension benefits results in higher than anticipated costs? What if Ireland was to enter a severe economic downturn characterized by low corporate profitability, unemployment, and reduced consumer spending? Windfall corporate tax receipts would certainly evaporate, while general tax receipts across the board would suffer, including PRSI, which inevitably declines as unemployment rises. Remember, Ireland is currently at full employment. This is as good as it gets in terms of PRSI tax receipts relative to the working age population. It it can only get worse from here. If such a downturn were to occur, would the government be able to service its obligations to the state pension fund without cutting benefits, expanding the national debt, and/or entering a period of austerity? KPMG presented a very adverse scenario, accounting for a multi-year recession, continuing conflict in Ukraine, and lower growth, whereby annual deficits in the social insurance fund reached €39.9 billion by 2076. So don't be fooled into thinking that any proposed solutions are in any way bulletproof. Things could very well turn out to be worse than expected. Let's also not forget that Ireland previously had a national pension reserve fund, the proceeds of which were largely used to bail out Irish banks post-financial crisis. Would the government siphon funds from a newly established state pension fund in the future if the state was in need of financing? Bear in mind, these are just some of the uncertainties that we know about. As has been clearly illustrated over the past few years, oftentimes it's the unpredictable events which cause the most damage. In conclusion, Ireland has a major state pension problem which requires immediate attention. The longer the government kicks the can down the road, the more intergenerational inequality it will create. There is no getting around the fact that at a minimum, PRSI rates and the state pension age need to increase. The sooner this happens, the better. Outside of salvaging the state pension, the government needs to do more to encourage investment in private pensions. Yes, auto-enrollment in 2024 will help address the matter of private pension coverage, but not adequacy. And it's adequacy which matters most. Educate and incentivize. That is the key to success. But let me know, what are your thoughts on the Irish pension situation? How do you think the government should address the challenges facing the state pension system? Leave a comment down below. If you found this video to be useful, can I ask that you take just 2 seconds out of your day to leave a like on the video, subscribe to the channel, and share the video with family and friends. Before you go, you might be interested in this next video, which reveals the truth about Ireland's corporation tax. Thanks very much for watching, and I'll see you soon.